In the last two chapters, we have learned a considerable amount about forwards and futures. In Chapter 5, we learned about stock futures and stock index futures. And in Chapter 6, we learned about futures contracts that are based on foreign currencies, agricultural commodities, precious metals, even the weather. Well, in this chapter, we are going to take a look at interest rate forwards and futures. So, for all the contracts that we're going to look at, the underlying quantity that determines how the contract pays off either is an interest rate itself, or it's a financial security like a bond whose value is closely tied to an interest rate. Okay, before we go on, let's talk about some very basics about bonds. And we're going to be focusing almost entirely on U.S. Treasury securities because they are considered to be free of default risk. They are also extremely liquid. There is a very large and very active market for U.S. Treasury securities, so you can buy and sell these at any point in time with very little difficulty, and you'll just about always get a very fair price. So pricing is extremely competitive because of the active trading. In addition, Treasury securities often serve as a benchmark for other debt securities that do have default risk, so it's a natural place to start here. First, let's talk about the different kinds of U.S. Treasury securities. The three basic varieties are Treasury bills, Treasury notes, and Treasury bonds. Sometimes for short we just call these T-bills, T-notes, and T-bonds. They are all sold by the United States government for the purpose of financing the national debt. Treasury bills have no more than 1 year until maturity when they are originally issued. So they are money market instruments. They are short-term investments. Treasury bills do not have coupon payments. There are no intermediate cash flows between the issue date and final maturity. They simply pay off the face value, and a common face value is something like $1,000, on the maturity date. Investors earn interest on Treasury bills simply by buying them at a discount below their face value and then receiving the full face value on the maturity date. So that's one important pricing concept for zero coupon securities like Treasury bills, is that they will always sell at a discount below face so that the investor can earn interest. For example, an investor might purchase a Treasury bill for $970 and then 1 year from today receive the full face value of $1,000 when it matures. That's $30 worth of interest on a $970 investment, so it's approximately a 3% rate of return over the year. That would be something pretty typical for Treasury bills. Now, Treasury notes and bonds are very similar to each other, and in fact sometimes you'll catch me referring to them both as simply Treasury bonds, and that's okay, because the distinction is not that much. Treasury notes, when they are originally issued, have between 2 and 10 years until maturity. So some people consider them intermediate term investments, whereas Treasury bonds can have up to 30 years until their final maturity. So they can be much longer term investments. But they're both issued by the government, and they're both structured in very similar ways. They both pay coupon payments, which, as you probably know, are periodic interest payments that are made to the bondholders every 6 months. When Treasury notes and Treasury bonds are originally issued, the coupon rate, that is the percentage that we multiply by the face value to determine the amount of the coupon payment, that coupon rate is purposely set in accordance with market conditions so that the notes and bonds will be sold at their face value when they are originally sold to investors. This is in contrast to Treasury bills, which always sell at a discount below the par or below the face value. Treasury notes and bonds, when they are first sold, are sold at the par value. Now, of course, market conditions can and do change. If interest rates go up after the notes or bonds are issued, then their price will fall below par, whereas if interest rates go down, their price will rise above par and cause it to sell at a premium. In addition to these securities that are sold by the U.S. Treasury, financial institutions have repackaged the cash flows from Treasury notes and bonds into instruments called Treasury strips. Now, in this case, the word strips is actually an acronym, although that isn't always the case in this course. But in this case, strips stands for Separate Trading of Registered Interest and Principal Securities. Each strip is created by bundling the cash flows that occur at a particular point in time on a group of Treasury notes or bonds. Sometimes that's based on a coupon payment that a group of notes or bonds will pay, and sometimes that's based on a principal repayment. Either way, the cash flow happens at exactly one point in time, and therefore Treasury strips are basically zero coupon securities. They pay off on exactly one date, and you could think of that as the final maturity. Here are some price quotes that you might see for Treasury bills, as well as notes and bonds, along with Treasury strips in financial publications such as the Wall Street Journal. Now, you'll notice that on the top line for Treasury bills, looking at the maturity date of October 18th, 2007, you'll see two numbers there. One is an asked number, that's 3.54, and it is a percentage, and then there's a bid number, which is 3.59%. Those numbers are yields. That is, those are interest rates, and they are calculated based on the bid and the ask price of the Treasury bill in the secondary market. The secondary market for Treasury bills is where investors can buy and sell Treasury bills at any time after they are issued by the U.S. government, and as long as it's before they finally mature. Now, there are a number of dealers that facilitate trading in that secondary market, and dealers will post two quotes for any given security. There will be a bid price and there will be an ask price. The bid price is the lower of the two. It's the price at which the dealer would be willing to purchase that Treasury bill from you. And the ask price is the price at which the dealer would be willing to sell that Treasury bill to you. Since the ask price, that is the price you'd have to pay, is a little bit higher, and the Treasury bill pays off the same face value at maturity, that means that the asked yield calculated from that price is just a tiny bit lower than the bid yield. But you generally don't have to worry about the spread between the bid and the ask yield being too large here, because as I said before, Treasury bills are very actively traded and pricing is quite fair and competitive. The same could be said of Treasury notes and bonds, but as you'll notice here, you see some different information in the price quotes. You do see a column for the yield, which is based on the last observed trading price. You also see a column for Treasury notes and bonds for a coupon rate. And of course, you probably remember what the coupon interest rate is from your basic finance course. That's just the percentage that we multiply by the face value to determine the total annual amount of the coupon payment that'll be paid to bondholders. What may look a little interesting or different to you is the price quotation. For example, let's take a look at the price quotation for the bond that matures on November 15th, 2008. You'll notice that this says 100:14. Now, this is actually a percentage of the bond's face value. That's how bond prices are almost always reported in the financial news, is as a percentage of par, as a percentage of face. But the amount that is listed after the colon, that is the number 14, refers to 30 seconds of a percentage point. So what you're looking at here says that this particular bond trades at 114 30-seconds percent of its face value. So just a little bit over par, which would be 100%. If you look at the bond price quote just below, you'll notice that this bond sells at 98 and 18 30-seconds percent of par value. So this one sells at just a little bit of a discount below face. Now, of course, if you look down this column at the coupon rates and the yields, you can pretty well tell, even without looking at the price, which ones are going to be selling at a discount and which ones are going to be selling at a premium. Remember from your first finance course that anytime the coupon rate is higher than the yield to maturity, that means that the bond is going to sell at a premium over face value. Whereas anytime the coupon rate, like in this bond's case, is lower than the yield to maturity, 3.5% is less than 4.22%, that means the bond will sell at a discount below the face value. Last, we take a look at Treasury strips here in these price quotes, and you'll notice that the only information really that's provided here is a column for price and a column for the yield. The yield represents the yield to maturity, which would be the interest rate that you earn on an annual basis if you own this security. The price is stated as a percentage of the par value, the percentage of face. And in this case, you'll notice that there are no 30 seconds of a percentage point reported. It's simply reported as a decimal. So the one maturing on November 15, 2008 is priced at 95.523% of the face value. Remember that Treasury strips are zero coupon securities. So like Treasury bills, they always sell at a discount below the face value. So you'll never see a price quote for a Treasury strip that is over 100% of face. On the contrary, it will always be at least a little bit below the face value, and the higher the yield, that is the higher the market interest rate, as well as the longer the time until maturity, the further from the face value it will be. As an example, if you'll take a look at this very bottom quote for the Treasury strip that has a cash flow coming in on February 15th, 2037, a long time in the future, that price is only 24% of the face value, because it's going to be a long time before the face value is paid on that maturity date.